The true barrier to your profit is not your analysis. You already know your system works. You have back-tested the edge. You can identify the setup on a historical chart with near-perfect accuracy. You know the exact moment the market should yield to your strategy. So why are you still losing money? The barrier is the gap. It is the vast emotional void that exists between knowing the signal and executing the wait. It is the unbearable stillness. You sit there, staring at the screen, watching price action churn, waiting for the one specific alignment of conditions you defined in the cold, clear light of Sunday planning. And as the minutes tick by, the waiting feels harder than any loss you have ever taken. Why? Why does sitting on your hands feel like such a profound act of self-denial? Because in that stillness you are confronted with the anxiety of potential profit slipping away. Every tick that moves toward your target zone but hasn't quite touched it screams at you, you are going to miss it. You feel the pressure building in your chest. That pressure is not external. It is your own impatience demanding action. It is the discomfort of being unproductive. You equate effort with execution. You believe that if you are not actively pressing buttons, you are not trading. This is the lie that kills intermediate traders. We need to reframe waiting entirely. Waiting is not passivity. Waiting is the highest form of active discipline. Waiting is not something you do while you wait for the strategy to appear. Waiting is the strategy. Think of the market as a disciplined predator. The market is not chasing you. The market is waiting for you to get bored. The market knows you have a weakness for action. It understands that the intermediate trader, the one who has tasted success but not mastered consistency, suffers from a dangerous form of hubris. You know your setup. You know the exact conditions that must align. But then you start to negotiate with the chart. You rationalize it's close enough. I'll just take a small position now to secure my place. I can anticipate the next candle. This is the curse. You fire too early, believing you can somehow will the market into place, that your mere presence will force the signal to complete itself. And what happens? You enter. The market pauses. It recognizes the premature entry, and it uses that position as liquidity, chewing up your stop before reversing and hitting the exact spot you were waiting for originally. You were right about the direction. You were right about the target. You were only wrong about the timing. And in trading, being wrong about timing is being wrong about everything. The market is designed to capitalize on human boredom. That feeling of dullness, of wanting to close the screen because nothing is happening, that is the subtle trap. It is the market whispering, "Just take a look over here, this move is happening now." You must understand that boredom is not a failure of the market to provide opportunity. Boredom is the confirmation that you are doing your job correctly. It means you are not chasing noise. But that boredom feels like a tax, doesn't it? It feels like you are wasting time, wasting capital, wasting mental energy. You are conditioned by modern life to seek constant stimulation and instant gratification. The trading screen demands the exact opposite: prolonged, deliberate, unblinking stillness. The intermediate trader sees a setup forming and believes they have solved the puzzle. They see the potential profit and their brain releases a surge of dopamine, rushing them toward the entry button. They trade the anticipation of the signal, not the completion of the signal. Why? Because anticipating is exciting. Waiting is agonizing. The market rewards the agonizing. Consider the cost of that premature action. It is not just the small loss you take. It is the erosion of your confidence in the system itself. If you take 5 premature trades and 3 fail, you begin to doubt the strategy, when in fact the strategy was never truly tested. Your impatience contaminated the sample. You must treat the signal definition as a literal contract. If the market has not signed the contract, you do not send the capital. Period. The market loves the impatient trader because the impatient trader is predictable. They will always try to get ahead of the move. They will always chase the last 20% of the setup. They will always provide the necessary fuel, your stop loss, for the true move to occur. Your job is not to predict the future. Your job is to wait for the future to align perfectly with your defined edge. If you find yourself constantly battling the urge to enter before the signal, you are not wrestling with the market. You are wrestling with yourself. You are fighting the primal need for relevance. You are succumbing to the subtle, deadly trap of boredom. But what if that boredom, that stillness, is the ultimate filter? What if the feeling of wanting to click the mouse is the exact sign you should step away? The market is testing your resolve. It is testing your capacity for discipline under duress. And the duress here is not volatility. The duress is stillness. We need to turn that waiting into a weapon. We need to understand the psychological root of this debilitating impatience, because it is not merely a technical error. It is a fundamental flaw in your relationship with control. Impatience is not a character flaw. It is the ego demanding relevance. Think about that for a moment. Why do you hate waiting? Because waiting implies that you are not in control. It means you are subject to the market's timeline, not your own. And the ego, that demanding, fragile part of your trading identity, despises the feeling of being sidelined. The ego hates the void. When you sit at the screen and there is no clear setup, the ego feels useless. It shouts, "We are a trader. We must trade. We must be relevant to the movement." This is the core driver of the half-signal trade. It's not about making money, it's about proving your value to yourself. We talk endlessly about FOMO, the fear of missing out. But I want you to look deeper. FOMO is almost always FOF disguised. It is the fear of failure. If you enter a trade prematurely and it fails, you can blame the market or the noise or the timing. You took action and you failed. The ego can process failure through action, because action confirms relevance. But if you sit there waiting for the perfect signal and that signal arrives and you execute and it fails, that failure is pure. It means your analysis, your system, your edge failed. The ego cannot bear the idea of being truly wrong while executing perfectly. So the ego pushes you to enter early. Why? Because if you enter early and it fails, you have an easy out. Well, I knew I shouldn't have entered, but I just had to get in. You trade poorly just so you can blame the poor execution rather than the flawed underlying system. It's a mechanism for self-protection against true accountability. You take the half-signal trade, let's define it precisely. The half-signal trade is the entry taken when 60% of your objective conditions are met, but the critical 40%, usually the final, non-negotiable confirmation, is still missing. It is driven by the internal desire to just be in something. The half-signal trade is the primary killer of intermediate accounts. It looks like a good trade. It smells like a good trade. But it is fundamentally a guest dressed up in technical clothes. You see price approaching your key resistance level. Context, met. You see volume starting to dry up. Confirmation, partially met. But you haven't seen the clear rejection candle close below that resistance. Confirmation, missing. And you jump in. Why? Because you fear that if you wait for the full confirmation, the move will happen without you. You fear the market will disrespect your patience. The irony is devastating. By entering prematurely, you guarantee that the trade will become emotional. You are now managing a position based on hope, not statistics. We hate looking at an empty screen. We hate looking at a chart with no setup. We feel unproductive. We feel like we are not working. You need to internalize this truth. Trading is not measured by the quantity of trades you take. Trading is measured by the quality of your waiting. If you are a swing trader, you might make 20 high-quality trades a year, That means 99.9% of your time is spent waiting. If you are a high-frequency day trader, your execution window might be 30 seconds, but your waiting window is still 99% of your session. The self-sabotage loop triggered by impatience is ruthlessly efficient. 1. Impatient entry. You take the half-signal trade. 2. Small loss. The market whipsaws, stopping you out for a minimal loss. 3. Emotional shock. The ego is wounded. It needs to recover the perceived loss. Now. 4. Revenge trade. You jump back in immediately, likely without a valid signal, doubling down. 5. Account blow-up. The revenge trade is sloppy, oversized, and psychologically driven. It leads to the catastrophic loss. All of this carnage, all of this emotional devastation, began with the inability to wait for the final 40% of the signal. You must understand that the market does not care if you are bored. It cares only about structure and liquidity. Your impatience is simply a subsidy to the market structure. If you master the art of disciplined inaction, you immediately filter out 80% of the noise that plagues your account. You eliminate the emotional volatility that leads to revenge trading. True trading wisdom is knowing exactly when not to trade. It is the ability to walk away from the screen when the conditions are ambiguous, or when the setup is 95% complete. If you are not trading, you are not losing confidence. If you are not trading, you are not paying commissions. If you are not trading, you are preserving your mental capital. The profound paradox of trading is that 90% of your edge comes from the 90% of the time you are waiting. The money is made in the stillness, in the preparation, in the cold, objective observation, not in the frenetic moments of execution. Stop treating trading like an action sport. Treat it like sniper duty. You wait for hours, maybe days, for the target to walk into the precise window you defined, and then, and only then, do you execute with mechanical precision. The moment you start feeling the urge to enter because the chart looks good or feels right, you are already compromised. That feeling is the ego asserting itself, trying to bypass the objective rules you set for yourself. We need to shift our focus now. If you cannot wait, it means your signal is not defined clearly enough. You are relying on subjective interpretation, and subjective interpretation is the playground of impatience. You are waiting for a feeling. You need to be waiting for an event. You must stop treating your trading plan as a set of flexible guidelines and start treating it as a literal contract of certainty. What is a signal? It is not a suggestion. It is not an indication. It must be a non-negotiable objective event that occurs at a specific point in time and space on your chart. If you are waiting for the market to give you a hint, you are guessing. If you are waiting for the market to fulfill a precise predefined condition, you are executing an edge. Your inability to wait often stems from a lack of faith in your own system. And that lack of faith is usually rooted in a lack of structural clarity. You leave too much room for subjective judgment, and subjectivity invites emotional entry. We must define the 3 pillars of a valid signal. All 3 must be present. If one is missing, it is not a signal, it is a guess. Pillar 1, context. This is the environment. Where are we in the larger market structure? Are we at a major weekly support level? Are we in a clear confirmed trend? Context defines the value of the trade. If the trade is technically valid, but the context is choppy, low volume, or counter trend, the risk is too high. Context defines the setup. Pillar 2, confirmation. This is the price action event itself. This must be the non-negotiable trigger. A specific candle closing above a key moving average. A specific reversal pattern completing. A breakout and retest holding the line. Confirmation is the market's signature on the contract. It cannot be anticipated. It must be observed. Pillar 3, confluence. This is the alignment. Do your indicators, volume profiles, or sentiment metrics confirm the context and confirmation? Confluence acts as the reinforcing evidence, ensuring that multiple market forces are aligning to support your thesis. If you are waiting for a signal and you only have context and partial confluence, but the confirmation candle hasn't closed, you have nothing. You have a potential setup, not an executable trade. The half-signal trader convinces themselves that context is enough. They say, "We are at major support, it has to bounce." They trade the context, ignoring the need for confirmation. They are betting on potential, not proof. Your job is to define the trigger zone with surgical precision. Waiting means standing guard on a specific line in the sand, not wandering the battlefield looking for action. If your plan says, enter a long trade if price closes above $100, then $99.99 is not the signal. It is close. It is tempting. But it is not the signal. The illusion of close enough is the ego's last stand. The ego whispers, it's 95% complete. That 5% is just noise. Get in now before the train leaves the station. But in trading, a signal that is 95% complete is 100% invalid. The market is binary. Either the condition is met or it is not. There is no partial credit for being close. If you allow yourself to trade the 95% signal, you are establishing a dangerous precedent that rules are negotiable when profit is imminent. Once you negotiate one rule, you have negotiated them all. Your system dissolves into discretionary chaos. The definition of the signal must be so clear that there is no room for emotional interpretation. It must be mechanical. If I woke you up at 3 a.m. and asked you to describe your perfect entry signal for the current trade, could you do it in 3 crisp, non-negotiable sentences? If you cannot, if you need 5 minutes to pull up your indicators and explain the nuance, you are destined to chase. You are relying on subjective judgment. And subjective judgment is vulnerable to the anxiety of the wait. The clarity of your signal is the physical manifestation of your mental discipline. A vague signal reflects a vague approach to risk. A precise signal reflects an uncompromising commitment to edge preservation. Stop trying to find signals. Start waiting for signals to complete their journey to you. The market will come to your trigger zone if the structure is valid. You do not need to meet the market halfway. Meeting the market halfway is how you surrender your edge. Now let's address what you should be doing while you wait. Because waiting is not sitting passively. It is intense mental preparation. This is the paradox of active waiting. Most traders view waiting as downtime, a period of boredom they must endure until the action starts. Successful traders view waiting as the most critical phase of the trade. While you are waiting for the market to sign that contract, you should be engaging in pre-mortem analysis. This is intense mental rehearsal of every possible outcome, executed before the trade triggers. You are not just looking at the chart. You are stress testing your emotional response to the execution. Ask yourself these questions while you wait. 1. If the signal completes and I enter and the trade fails instantly, hitting my stop loss within 2 minutes, how will I feel? What is my immediate mechanical response? The answer must be, I feel nothing, and I immediately prepare for the next setup. 2. If the signal completes and I enter and the trade runs immediately to 5R, what is my exit strategy? Where do I lock in profit? Where do I move my stop? Will I be tempted to hold for 10R, violating my plan? 3. What if the signal completes, I enter, and the price just consolidates for 4 hours hovering around entry? Will I feel impatient? Will I move the stop loss closer out of fear? Or will I stick to the structural stop? You are rehearsing failure and success. Why? Because the moment the signal triggers, your conscious, rational brain must switch off, and your mechanical, programmed response must take over. You cannot afford to think in the moment of execution. The thinking must be done entirely in the waiting period. The difference between anticipation and execution is everything. Anticipation is the analysis phase, calculating likelihoods, defining risk, setting the trigger. This is the intellectual work, the mental heavy lifting. Execution is the robotic patience phase, pressing the button when the light turns green and managing the position according to the pre-written script. The intermediate trader confuses the two. They try to analyze during execution, and they try to execute during anticipation. They let the fear of missing out pollute the analysis, leading to the premature entry. You must cultivate detached observation. You must be fully engaged with the chart, watching every tick, every volume spike, but you must be emotionally disconnected from the outcome. The signal is external. Your response must be internal, and it must be purely mechanical. Imagine you are watching a video game played by someone else. You can see the setup, you know the controls, but you cannot physically interact. That level of emotional separation is necessary. The market is simply a data stream. It is not an adversary, and it is certainly not your friend. Why do successful traders often look bored? Because they have already done the hard work. They defined the contract. They performed the pre-mortem. They set the alerts, and now they are simply waiting for the signature. The moment of entry is not exciting for them. It is merely the fulfillment of a pre-existing obligation. The excitement is what kills you. The rush of the premature entry is the drug the market uses to extract your capital. Use the wait time constructively. Do not stare blankly. Use the time to strengthen your risk management plan. Re-verify the stop-loss location based on current volatility. Define your scaling points. Ensure your risk exposure is precisely what you intended. The wait time is your insurance policy. Every minute you wait for the full confirmation is a minute spent reinforcing your structure against the inevitable emotional assault that comes after entry. If you are waiting, you are preserving your options. You still hold all the control. The market has not yet taken your capital, nor has it rewarded it. You are in a state of perfect neutrality. And this is the truth I want you to internalize. The most profitable moment in trading is the moment just before you enter, when you still hold all the control. Once you press the button, control is partially surrendered to the market dynamics. Do not surrender that control prematurely. Protect the moment of neutrality fiercely. Now we must quantify the cost of premature action because many traders only measure the cost of the stop loss. The true cost is far deeper and more devastating. The direct monetary cost is obvious. Slippage, worse risk-reward ratios, unnecessary commissions. When you fire early, you often enter at a worse price, meaning your stop loss must be wider relative to your target, or your R multiple is immediately compromised. If you were aiming for 3R, the premature entry might immediately reduce that potential to 2.5R, but that is the smallest tax. The devastating cost is confidence erosion. Every impatient trade chips away at your belief in your own system. You take a loss on a half signal, and the next time the full signal appears, you hesitate. Why? Because your subconscious has logged the previous attempt as a failure of the system, not a failure of discipline. You start to tinker with your variables. You move your stop loss. You change your entry criteria. You introduce complexity to fix a problem that was purely one of execution simplicity. This spiral of doubt is the true account killer. The psychological tax of impatience is massive. Impatience creates noise. When you are constantly looking for a reason to enter, your mind is flooded with low-quality information. You see patterns where none exist. You start watching lower time frames obsessively, trying to find micro-confirmations for a high time frame signal. Noise prevents focus. And focus, the ability to identify and mechanically execute your high-probability setups, is your only true edge. And when you take an impatient trade, you are paying a double tax. First, the financial cost of the loss. Second, the attention cost. A bad entry requires emotional management. It demands your focus. You are now spending mental energy managing a trade that never should have been taken, distracting you from the next valid setup that might be forming simultaneously on another chart. You miss the good trade because you are emotionally tethered to the bad one. This compounding effect of bad entries creates a perpetual state of stress. You are constantly fighting fires that you started. If you are trading impatiently, you are trading from a place of scarcity. You believe this opportunity is the last one, and you must seize it now. This scarcity mindset reflects a deep underlying insecurity about your ability to generate profit consistently. The market is a mirror. If you are impulsive in your trading, you are likely impulsive in other areas of your life, your diet, your spending, your relationships. The chart simply reflects your inner lack of discipline. You cannot be a disciplined trader if you are an undisciplined person. The stillness required to wait for the signal is the same stillness required to let a bad habit die. You need to calculate the value of your mental capital. How much mental energy do you waste managing trades that never should have been taken? How much focus is diverted? How much sleep is lost? If you could bottle that wasted mental energy and use it to refine your strategy, backtest your edge, or simply rest, how much would that be worth to your overall profitability and longevity? The cost of impatience is not just a dollar amount. It is the cost of peace. It is the cost of clarity. It is the cost of the quiet confidence that defines a truly successful trader. Stop paying that tax. It is time to move from understanding the problem to implementing the solution. We must build the waiting muscle. This requires physical and mental training, not just intellectual agreement. You cannot simply wish patience into existence. You must program it. The first practical drill is the forced detachment drill. You must break the screen addiction cycle. The constant monitoring of price action, even when there is no setup, is what fuels impatience. It keeps the ego engaged and demanding action. Implement mandatory 20-minute breaks every hour, regardless of market activity. Set a timer. When the timer goes off, you must physically step away from the desk. Walk around, drink water, look out the window. If you are waiting for a signal and the timer goes off, you are not allowed to watch the signal trigger. You must trust your alerts. This drill forces you to decouple your presence from the trade outcome. It trains your brain that the market will move whether you are watching it or not. The 1-hour rule is the next layer of defense. If you are trading on time frames higher than 15 minutes, commit to only reviewing charts at the top of the hour. You are only allowed to make decisions based on the hourly candle close or the 4-hour candle close. This forces discipline against minute-by-minute obsession. It trains you to ignore the noise and focus only on structural shifts. If the signal is not complete at the moment of your scheduled review, you must wait another hour. No exceptions. The vast majority of premature entries occur because the trader is constantly checking the 5-minute chart, trying to find micro-confirmation that the 1-hour chart hasn't provided yet. The 1-hour rule eliminates this self-destructive behavior. Next, utilize the power of posture and breathing. Your physical state dictates your mental state. If you are hunched over the screen, gripping the mouse, shallow breathing, your body is communicating tension and anxiety to your brain. This physical tension translates directly into twitchy execution. Use physical stillness to enforce mental stillness. Sit back. Shoulders relaxed. Focus on slow, deep, diaphragmatic breathing. If your body is jittery, your finger will be twitchy. Before you even consider an entry, adjust your posture and take 5 deep breaths. Use this ritual as a pattern. Interrupt against impulsive action. The simple act of physical relaxation reinforces the idea that you are observing, not participating. You are the sniper, not the infantryman. We must also introduce the concept of opportunity cost of time. The intermediate trader believes that more time at the screen equals more opportunity. The successful trader knows that trading less gives you more time to refine your strategy, which is the real profit lever. Every hour you spend waiting patiently is an hour saved from managing unnecessary losses. Use that saved time. Refine your signal definition. Backtest your failure points. Read charts not for entry, but for structural clarity. The highest value activity in trading is not execution, it is preparation. By mastering the wait, you free up mental capacity for preparation. Finally, the accountability log. This is a crucial drill for quantifying the ego cost. Document every single trade you take, but specifically document every impatient trade, the half-signal trade. Do not just record the dollar loss. Assign it an ego cost score. The ego cost is a subjective measure of how much emotional stress and confidence erosion that impatient trade caused. Rate it from 1, minor annoyance, to 10, catastrophic confidence hit. By explicitly tracking the ego cost, you externalize the psychological burden. You force yourself to see the emotional price tag attached to your lack of discipline. You realize that the $50 loss on the premature entry caused a mental cost of 8 out of 10, which then led to a $500 loss on the revenge trade. This log makes the invisible cost of impatience visible. It transforms the abstract concept of discipline into a quantifiable metric. The goal of these drills is not merely to force you to wait. The goal is to fundamentally change your relationship with time and pressure. When you master the wait, you decouple the concept of profit from the concept of action. You understand that the biggest gains come from the longest periods of stillness. This mastery will fundamentally change not just your trading, but your entire approach to decision-making under stress. You will stop reacting to the immediate impulse and start operating from a place of calculated, deliberate action. We have covered the cost, the psychology, and the implementation. Now we reach the final synthesis. Waiting is not a means to an end. It is the end itself. It is the mastery of self. If you are waiting correctly, you are operating from a place of certainty. You are resting in the knowledge that your edge is statistically sound, and all that is required of you is mechanical execution. The ultimate signal is not a candle pattern or an indicator cross. The ultimate signal is internal. It is the moment you feel zero emotional pull to enter a trade that does not meet your criteria. It is the moment you can look at a chart moving violently without you and feel nothing but stillness. That stillness is your edge. When the market is screaming and everyone else is panicking or chasing, you are quiet. You are standing guard on your line in the sand, waiting for the precise, objective condition to be met. The reward of patience is not just monetary. It is longevity. It is peace. It is the compounding success built not on emotional reaction, but on mechanical execution. You are trading probabilities, not certainties. And probabilities require time to play out. If you rush the process, you contaminate the probability. You introduce the human element of fear and greed, which are the ultimate statistical anomalies. Your success is determined by how long you are willing to wait respectfully for the opportunity to present itself. The market owes you nothing. It will not adjust its timing for your boredom or your rent payment. It moves according to structure and liquidity. Your job is to be the disciplined observer, the mechanical executor, the patient predator. Wait for the signal. Wait for the contract to be signed. Wait until the conditions are so perfect that the entry feels boring, inevitable, and entirely devoid of emotion. That boredom is the sound of compounding profit. That stillness is the sound of mastery.